our results have been over the last 6 months or so, go over specific trades, and talk about our win rate, et cetera. And then I'm gonna go into over some charts, et cetera, but I'm also gonna get into options and spend quite a bit of time on basic, what I consider basic options information. I'm not gonna dig deep into Black Scholes or anything like that, but I do want to cover a lot of basic stuff, so folks who may be somewhat familiar with options, but don't know a lot of the intricacies, we'll go over that as well. So again, thank you very much for joining, and we'll get started. So again, my name is Dave, and I'm with a Compass Options Room and an alert service. I have a room that runs every day, 5 days a week, and also an alert service where we send out alerts on the trades that we take. All right, so this is just what we call a SPY super system. It's one of the methodologies that we use, and I'll cover a little bit of that. Again, I've been trading for about 14 years and full-time. I traded a lot more before that part-time, but I've been trading for a good long time. And an interesting story, people ask me about how I get started to become a full-time trader, a professional trader. And it's kind of a funny story. I don't like to talk about myself a lot, but I get asked this all the time. So what happened was I was in IT, I was in information technology for a long, long time. And I was working for a local company. We were a shop where we did cloud computing for lots and lots of companies. We had a lot of servers, and it was a fairly intense operation. But cash flows got a little tight in December, 14 years ago. December, about 2 weeks before Christmas, my boss, who I was a good friend with, told me that he had to lay me off. The cash flow had been kind of got bad toward the end of the year. He hoped to be able to bring me back. So he laid me off about 2 weeks before Christmas. I had been trading part-time, so I said, this is kind of a good opportunity for me to just sit and trade at home full-time, to sit in front of my computer and trade full-time. So I did that in December, and it was the last 2 weeks in December, Christmas time, New Year's, not the best time for trading, but I did okay. And then in January, I had a really good month trading full-time, and I said, oh, this is pretty nice. I've never really done this full-time before, but so I was doing that full-time. And then February was also good. About halfway through the month, I had been doing extremely well. And interestingly, in middle of February, my boss called me and said, things have picked up. He'd really like me to come back. Could I come in and start Monday and get back to the job again? And I said, I really appreciate that. Appreciate the invite, but I can't afford to work for you anymore. And this has been too lucrative, so I'm going to just stick with full-time trading. So that's actually how I get into full-time trading. I never really had a plan to do that, but it just worked out like that, and was pretty advantageous for me. So anyway, that's how I get started. All right, so here we go. I have to do the disclaimer here. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right. And if you have any questions, by the way, you can just put your name or number in the question box or in the chat box, and somebody, Rory specifically from Right Line, will call you back later on, day or two, and answer any questions you got. He'll just call you once. He's not soliciting. He's just there to answer questions if you maybe have some questions that we can't take care of today. All right, and this is just a kind of a graphic on what we call the SPY super system is here, and basically track institutional money flow. This is how we find one of the things we use to find the highest probability trade setups, which is what we do in the room. All right, and this is just a graphic of the alert service. This is how you get alerts on the trades that I take. It just comes out on your phone. It'll tell you what the option is, et cetera, and what the price to pay and the expiration date, et cetera. I'll go over all the details of that. All right, so the first thing I want to talk about before we get into this, and I start every webinar with this, is understanding what drives a market. When a market's trending, what's actually making it move up or down. and when is a good time to get in follow the trend, and when is it not a good time. And the market consists of a lot of retail traders like myself, and I suspect everybody else in the room. A lot of retail traders. We as retail traders, we cannot move the market. We just can't. A lot of retail traders think they can move the market. They can't move the market. So we're in here just trading. Now, if just retail traders are trading a particular stock or an ETF, et cetera, at one point in time, what you end up with is this choppy market. It's chaos and it's chop. What happens when the institutions, and these are the institutions, this big marble here, these are the folks that drive the market. This is when a trend is when a stock is trending one way or the other, this is who's creating the trend, the institution. Now, the institutions are made up of several different things. They're made up of big banks. They're made up of big banks, and sorry, I just got a Skype call. They're made up of big banks such as Goldman Sachs, Morgan Stanley, et cetera. Also, they're made up of hedge funds. There's dozens and dozens and hundreds of hedge funds. Now, the hedge funds, just like the investment banks, they have billions of dollars that they can use to move the market. And you've also add in there things such as mutual funds. That would be things like Vanguard, T. Rowe Price, just again, hundreds of mutual funds with all kinds of different funds within that with mutual funds. They also can move the market. They have billions of dollars to move it. And then you have things such as pension funds, big pension funds, and that state pension funds, police pension funds. These folks, again, have billions of dollars that they can use to move the market. So we, when we know if these folks are in the trade, this is what we want to follow. So if you're looking to be profitable in a market, you don't trade when these people are trading. You trade when these people are trading, but you take money from these people. So we take money from retail traders. We don't take it from the institutions, but we do this by being in the market when the institutions are in there and making and creating a trend. And that's what I'm going to show you how we do that with my Compass Options room. All right, so we have inside the room, we have some rules to trade by. One is we trade the best and skip the rest. Excuse me just a second, I got a question here. Will we learn to calculate our risk size in the seminar? Let's say I have a $200 account. We want to risk, let's say, 10% of the account value for an option trade and credit spread. Yeah, I mean, I'll show you what your risk is with options. It's very, very simple to calculate. All right, so we trade the best and we skip the rest. And this is something I repeat in the room every day. Our objective is not to make trades. Our objective is to make money. This strikes people as odd. A lot of people with traders think they need to be making trades all the time. We don't. We just try to trade only the best trades. So our objective is not to make trades. Our objective is to make money. We do that by taking the very highest probability trade setups. Now, we also need, as a retail trader, we need an edge over other retail traders. And these are the edges that we have. I use what's called the right line compass system. This is a system I'll show you. This is what I use to determine whether institutions are in a trade or not in a trade. We trade relative strength and relative weakness. This is really, really critical. This doesn't mean RSI. This means how is the stock that you're thinking of trading, how is it performing versus the SPY, this S&P 500, or the triple Qs, or the NASDAQ? Because you want to be in a stock long only if it's outperforming the SPY or outperforming the Qs, or underperforming the SPY if you're going to be short. So that's another edge that we have. We trade with the market trend. If we have a trending market, what we're going to do is we're going to look to take trades in the direction of the market for that day, and also on the longer term trend. So as with the market's trending right now, it's bullish. It's been very bullish. We're basically looking to do longs. If we want to trade shorts on an intraday basis, for example, we can do that if the market is trending down. But if the overall market is bullish and the intraday market is bearish, we're not going to keep those overnight. We're just going to intraday trade that. And another key edges we have is we buy at or near support and sell at or near resistance. This is really important. You don't want to be chasing stocks higher or lower as they stack red and green candles, because you're going to get, a lot of times you're going to get trapped at the top, trapped at the bottom. So we wait for stocks to pull back to a support level, bounce off the support level, and get back into the trend. So these are the edges that we have here. And again, the compass system, and I'll show you this in a little bit. I have it running on Thinkorswim. It identifies the highest probability trade setups while sidestepping setups that look good but will fail more often than not. And this is done by knowing of identifying when institutions are in there and when they're not. Again, the compass does this by identifying when institutions are driving the move and when they're not. And the compass system analyzes complex data and displays the results in easily identifiable format. And I'll show you some of those so you can see that. And again, this visual element makes it possible for even new traders to find high probability trade setups. This is really important. Trading high probability trade setups is what gives you a very good win rate. And it's really important to be able to identify those high probability trade setups. So again, getting an edge over the retail traders, again, individual trades, we take trades that are being driven by institutions, I keep saying. This is really critical. We only want to be trading if an institution's in the trade. We don't want to be trading if institutions are not in the trend, and that means that the retail traders in there. We don't want to be in there with just them. We're again trading in the direction of the overall market. Again, our trades are going to be supported by institutional buying and selling. They'll be outperforming the SPY or the triple Qs, and they're going to be moving in the direction of the overall market. This gives you a huge edge in the trades that you take. Okay, this is a kind of a high probability trade setup funnel that I kind of just created here. I did a video on this. This is kind of the checklist I go through to find whether a stock is a high probability trade setup or not. The first thing I look at is I want my daily chart and my 5-minute chart to align. So if I'm going to go long a trade, the 5-minute chart needs to be bullish, the daily chart needs to be bullish. If the 5-minute chart is bearish and then it turns bullish, that's fine. But my key here is the daily chart. I'm only going to trade in the direction of the daily chart. I'm not going to take any trades long if the daily chart is bearish, and vice versa. Now, once I know that the stock I'm looking at meets that criteria, then I want to trade with the trend of both stock and the market. So I'll look at the market trend for the day and the market trend overall. And if I've got a bullish trend on the day and a bullish trend in the market, I'm going to trade long. Then I look at the compass indicators to make sure that the institutions are in there. So once I've identified these and I know that the institutions are in there, that gives me another piece of information I need to know that I should take this. Then I look at relative strength and relative weakness, which we just talked about. So if my stock is relatively strong and it meets these other criteria, it becomes a good candidate. And then, is it near support or resistance? If not, I can put an alert to make it let me know when it's near support or resistance, and then trade it. If all of these things are met, then the stocks that drop out the bottom of this funnel are the ones that are likely to be high probability trade setups. Okay, so that's kind of the process I go through in the room, and the stocks that come out to the alert service are all going to meet these criteria. And again, this is just the funnel method, just kind of written out here. Identify the market trend for the day. The green ones are important. Stock to be traded should have a daily and 5-minute chart aligned, as I just said. The compass indicators must align in the direction of the trade. In other words, institutions are in there. Relative strength, relative weakness. On the 5-minute chart, the stock price should be above the volume weighted average price, the VWAP, which is I'll show you in on the charts. It should be above it for long and below it for a short. This is the key level that the institutions use. It also should be near confirmed support for long and resistance for short. And if you look at the daily chart, there should be no nearby support or resistance on the daily chart to limit profit targets. And the key thing is to have patience. We're in the room, we're very, very patient. We'll go through days when we don't take trades. Most days do we take some trades, but you have to be very, very patient. Okay. Let's check. I got a couple of questions here. How long have I been using the compass system? Well, I'm starting my 3rd year in the room. I had the compass system about 6 months before I started the room, so 2.5 years, a little more. All right, so this is the strategies that we use in the room, and these are, of course, the strategies that are going to generate the stocks that go out to the alert service. I use straight calls and puts, of course, a lot of straight calls and puts. I use debit spreads using weekly options expiration. I also use time spreads, sometimes called calendar spreads. This is only a trade I use over earnings. It's the only way I trade over earnings is with a time spread. What it does is it captures the volatility crush when the earnings are released. The premiums drop on the options, and by selling some calls for this week, I actually capture the volatility crush. We just had a really nice one yesterday as well on Marvel. We did that on Thursday night, collected Friday morning. We went in like at 3 o'clock on Thursday, at 3 o'clock in the afternoon. We closed it at about, I think about 9:32 on Friday morning. And it was not about 45% on that particular one. We do these, but it's very specific criteria. I also do what's called a weekly ATM strategy. This is basically to capture premiums. It's kind of similar to a credit spread, except what I'm doing is selling puts every week against a much longer dated put out in time to just capture premium week after week after week. And I call it the weekly at the money because I'm doing at the money puts. But I also consider that an automatic cash machine here. So that's why I call it ATM. And we do credit spreads to capture premium over a few weeks. We're in run right now. We just closed one last week, but we do a lot of these. And the SPY Super System, which I've mentioned before, is basically for high probability trade setups to catch the SPY or the Qs. A lot of people like to trade the SPYs and the Qs. So we have a super system set up for that. But I only call those out in the room. I don't send out alerts on those because they're much too quick. A lot of times we'll get in, it'll be three 5-minute candles and out. All right, so that's what we use in the options room in the alert service. Now, just to quickly talk about the alert service, who's it for? Well, it's designed for day trades and short-term swing trades. This is not an investment service. I don't use I don't suggest trades for investments using fundamentals or anything. It's for day trades and short-term swing trades. I'm using institutional involvement, and I'm using technical analysis. Again, it's designed for traders who can't or don't want to watch the market all day. And the real-time alerts are going to be going out on only the highest probability trade setups. I only take the very highest probability trade setups based on that little funnel that I showed you. And how do we find the highest probability trades? By identifying institutional involvement, market internals, which tells me what's going on in the market during the day, and detailed technical analysis. I drill down on technical analysis to find them. So that's who the alert service is for. And this is just a P&L of I think it was back in the fall, just to show that the room's doing pretty well. What I want to do is I want to go through some of the results that we've had, just to give you a flavor for what to expect. Some people think you're going to get 300, 400, 500, 600% gains on trades that you take. We don't do that. And first, there's no way you're going to be able to do that consistently and be consistently profitable. We're looking, and I'll show you. I'm showing you the exact percentages we get. We're looking to tick off 20, 25% in a day, maybe 50% overnight, something like that. But this is just kind of a recap of what happened in March, April, May, and June of last year. I should probably update it. I've got some other positions, other results in here too. But March, April, May, and June last year, you can see we had 37 wins, 6 losses. So our win rate was between 86 and 87.5%. This was the total profit produced each month if you were investing $2,000 in each trade. I just use that as a base. I mean, everybody invests different amount of money in each trade, but I want to have something to go by so I can compare results from month to month, etc. So again, we had really consistent profits here. You see, we had a higher win rate here, but lower profits. A lot of it depends on the market. If the market's trending, you can stay in trades longer, you can take bigger size, but you're going to get more profits when the market's trending than you are when it's chopping. But that was a pretty good series of months right there. And so what I'm going to do is I'm going to go over my results from September through February, just to show you what kind of results you can expect trade by trade, percentage wise, because I want everybody to be comfortable. If you're looking for a 1,000% return on trade, it's not going to happen here. All right, so this is our September trades, And we had 25 trades, 25 wins and 2 losses, 92% win rate, which is pretty high. I don't usually get much higher than that. Usually my win rate's about 85 to 88, 89%. But 2,000 invested in each trade created 77.88 profit. And I did make a note, the September trading results were outstanding because it was really a hard month to trade. A lot of choppiness, a lot of gaps up and down. But you can see the percentages that we take on the trades that we do. UPS 23%. This was AI 43%, 16% in Lilly, a little 5% in Square. And we do have losses. You can see we had a couple of losses in here. This Amazon was on a news event, kind of caught you off guard. There's nothing you can do about that when the news comes out overnight. But again, we did make 108% on STX. That's one of our better trades percentage-wise. But you can see you got 10, 20, 25, 30%. This is normally what you can expect on the trades that you get in the room and what you can get what you can get on the alert service. They're going to be similar. We do call out more trades in the room than we do in the alert service for multiple reasons. One, if it's only going to be a half an hour trade, I don't alert because it's not fair to the alert cut members because they're not going to have time. And if I take a trade like at 10 minutes of 4, I'm not going to alert on it because they're not going to have time to get into the trade. So there'll be more trades in a room than there is in the alert service. All right. Somebody's asking, is $2,000 trade the option price or the risk? No, the 2,000 is what I'm saying there is that's how much you actually put into the trade. That's your maximum loss on a trade. So if you bought, let's say the options were going for $1 and you bought 20 options, that'd be $2,000. That would be your maximum risk. Option trades are always defined risk, always defined risk. All right, and how long is each option trade? It depends. I mean, some of the trades are intraday, and some of the trades are overnight, or some of them will go 2 weeks. Not much more than 2 weeks, though. Very rarely. The credit spreads would go out for 2 or 3 weeks, but most of the trades are over with a few days. All right, so let's go just over the October results here. And again, you're seeing the same kind of percentages, different stocks, but same kind of percentages. You see a few losses in here. Again, there are always going to be losses. But again, 32, 20, 14, 6% Tesla, a little small one here, but fairly consistent. And 61% in JD was pretty nice. October, 24 wins, 4 losses, 86% win rate, 44.80. That was our results in October with 2,000 put into each trade. November, percentages, you notice the percentages, they stay really, really close every month. We're getting, this is the kind of results that you're going to expect. And I want that to be clear. I want it to be clear that there's so many videos out there with people promising you the world, you know, hundreds and hundreds of percents every trade. They'll cherry pick a few trades, how great this was. You're not going to be consistently make money with that, taking that much percentage gain, because you're taking trades that aren't going to work very often. All right, so this was November. Again here, 21 wins, 4 losses, 84% win rate, one of the lower win rates, but we still made 51.60. And you see we got a credit spread here. I had a couple of strangles, another credit spread up here. But this was Palantir here, 31%, which we're in again right now, by the way. 40% on the strangle, 15% of DXCM. So you can see here, again, each month we had losses. Not too many. We not have too many losses. This was December, very slow month. We didn't trade a lot in December, a lot of holidays, choppy market. We didn't really do an awful lot. We only had 16 trades, 14 and 2, 87.5% win rate, 2,000 invested, netted 3,115, which, I mean, that's low compared to what we really do. I mean, that's not bad, but it's not consistent with what we usually do. Had a couple of losses in there, and some decent wins, you know, 36%, 63% of Microsoft. That was really nice. 30%. You know, it stacks up fast when you're doing 25, 30, 35% of trade. January, this was a good month for us. 20 wins and 2 losses. We actually had 20 wins and no losses, but there was a couple of trades we opened in January that closed in February, so I put the results back into January because I opened them in January. But 90% win rate, 2,000 invested, produced 75.05. Again, percentages not varying much here. You know, I mean, they're usually 10, 20%, up to about 40 or 50%. We had Mara, we had 65, so pretty good results. And here's February. This I broke down a little bit more information on here, but again, 24 wins, 2 losses, 92% win rate. Again, a very, very good month for us, February. Very good. 2,000 invested, netted 11,745. So it's a big month for us. We had a lot of trades that produced really, really good results. You know, we had 40% here, we had 50% FT&T. You know, when you're getting that higher percent, AMD 80%, when you're getting those kind of returns, it jacks up the profit pretty quick. Now, I broke down the alerted trades because there is a difference in the number of trades in the room and the alerted, as I mentioned. So we had 22 trades on the alert service and 26 trades overall. But in the alert service, 20 wins and 2 losses, and netted 69.30. So pretty good. I mean, that's pretty good for the alert service because those are typically really long-term day trades or overnight trades. All right, and just to kind of recap, before we get into some more details, I just kind of wanted to show you what 2023 trade results look like using $2,000 a trade. Investing $2,000 in each trade, taken in the Compass option room, produced a profit of $60,208, so about $60,000. And I'm assuming here that if you used a $5,000 account, each trade would have used 4% of your account balance when you started. And the percentage was lower as the account grew. It produced 120% return on the initial 50,000, growing to 110,000 at the end of the year. So pretty good. I'm pretty proud of that. This is a really great return, it really is. Like, so at the end of the year, the $2,000 trade would have been less than 2% of your final accounts balance. And some people chose to, of course, raise the amount they were putting into each trade, but this is just using 2,000 as a baseline on that. All right, let's see if we have another question here. The large loss trades, for example, Oxy, overnight, days out, do we typically use advisor stop loss? I don't, listen, Mike, I'll talk about this a little bit later, but I don't put stock losses based on percentages or anything. I'm looking at technical analysis on the stock. I'm looking for a stock to stay bullish and to stay above support, and that's the keys. As we get closer and closer to expiration, then I have to make adjustments to that. But most of the losses that are big, the stock just churns sideways, or we get a news event. Most of the big ones are news events. Some news comes out, you know, in Boeing, you know, the door flies off the plane, the stock plummets overnight, and nothing you can do about that when you're in options. Basically, you're going to be trapped in there. Can I guide on unusual option activity? I have a news service, a news feed that I use, so I do get alerted on all unusual option activity that's going on. I use them sometimes. It depends on the stock. Okay, so let me just go over the alerts and what you're going to see. This is what's going to come through on your phone. You're going to get a stock symbol, obviously. It's going to say Microsoft. The option strike price. Okay, so we're going to take the $230 calls or whatever. Option expiration date and the price to pay for the option. So everything that you need to do the trade is just going to be listed, and you can put the trade in based on that. And the price to pay may be a range. It may say $1.05 to $1.10, something like that. Now, usually I don't put when I put out an alert, I'm not putting the sell price in there most of the time. Sometimes I do. I do on time spreads over earning, but other than that, most of the time I wait to see what the price action is like for the rest of that day, and then perhaps overnight and what it is the next day or two, and then I'll put a profit target in once we've watched the price action a little bit. We have a better idea of where it's going to go. But then I'll be sending out an alert with the sell price on it. You'll always get an alert that tells you, okay, we're getting out of Microsoft now. We paid $1.05 for it. We're going to get out at $1.65 or something like that. But you'll always get that. And anytime you get an alert that tells you to do a sell, then what you want to do is you want to make it good till canceled, GTC, so that if you don't happen to be in front of your computer the next morning when the market opens and the stock pops up and hits your profit target, you want to have it working, so you don't miss it. All right, so again, how do we achieve these stunning results? Now I'm going to go over again what I'm looking at for high probability trade setups, just so you can see where these stocks are coming from. some people, if they're in the alert service, they really don't care. They just want to get the trades and make money. But I think it's important for a lot of people to understand where these trades are coming from, why we're taking specific trades. So we're able to identify when the institutions are driving a trade and when the market internals are heavily bullish or bearish. So I can identify these two things by using two pieces of software. And we only take trades when both of these are in our favor. That's not entirely true. If the institutions are driving a trade and the market internals are neutral, in other words, they're just chopping around, we'll take the trades. As long as the institutions are in there, we'll take them. So again, trade the best, skip the rest. So how do we identify these high probability trades? We do what's called a triple screen assessment, and I'll show you how we do this with the Compass system. Triple screen assessment is a fancy way of saying fractals or multi-time frame comparisons. So we look at three different indicators. We look at the momentum, we look at the trend, and we look at the money flow. So we're looking at the momentum and we're looking at it across current time frame and multiple time frames. We're looking at the trend across current time frame, multiple time frames. Looking at the money flow across multiple time frames. This is more important on multiple time frames. So that's the three things we use. When you've got the momentum moving up on current time frame and additional time frames, like the 5, 15, and 45, you've got the trend moving up on the 5, 15, and 45, and you get the money flow moving up on the 5, 15, and 45. All three of these particular indicators all moving in the same direction across multiple time frames. The likelihood that institutions are pushing that price up is well up in the high 90%, 94, 6, 97, 98%. It's very unlikely to have these three things trending across three different time frames and not have institutions driving it. So that's what we look for. Is money flow same as volume increase? No, it's not the same as volume increase. I mean, I look at volume. Don't get me wrong, I look at volume, but volume doesn't necessarily, it helps to let you know whether institutions are in there, but it's not the be all end all. And money flow is completely different. I don't want to get into too much of the details. We'll be here all afternoon. Now this is, before I get into options, I just want to show you what the Compass system looks like. This is the Compass system running on Thinkorswim. I use it on Thinkorswim. And this is actually a trade we took here quite a ways back, but I just wanted to show you. Now these candlesticks here, by the way, are Heikin Ashi candles. I use standard candlesticks, but I'll use Heikin Ashi off and on during the day looking for reversal confirmations. But this was a 5-minute chart of Tesla. Now these are the indicators I talked about. This is the long-term trend. This is the multi-time frame momentum. This is the current time frame momentum, and this is the money flow. These 4 different things, and they can be either green, blue, yellow, or red. If they're green and blue, it's bullish. If they're red or yellow, it's bearish. And you want all of these to be aligned up, or as many of them as possible, especially the multi-time frame momentum and the current time frame momentum. If these two aren't lined up for me on the daily chart as green or blue, then I'm not going to take the trade long. I'm waiting for those momentums to confirm. But so this shows you can see this is a 5-minute chart. You can see the green across the board. And that's why I said that the Compass system can take a person who isn't really an experienced trader, and it doesn't take an experienced trader to look at this chart and know that Tesla is bullish and that the institutions are buying it. I mean, that's absolutely the indication here that the institutions are in here buying the heck out of Tesla, and you can see the continued nice trend up. Jack, what are the time frames used? The time frames that are used on the 5-minute charts at 5, 15, and 45. On the daily charts, it's 1 day, 3 days, 9 days. You get those 3 time frames is what it crunches. All right, so that's what the Compass system looks like. We'll get into that a little bit later, but I did want to just kind of wanted to show you what I see on my Thinkorswim platform for indicators. Again, this is a couple things. This is a current time frame momentum right here. This is short-term momentum. And this here is what's called a dynamic compression zone. The Compass system develops or creates a compression zone, and it also puts out these what we call pop signals, or pop out of the box signals. This tells you that the stock is breaking out of compression, which is why we took it right here. Okay. All right, so I want to talk about options, and I know a lot of people came to talk about options. Let's just get into talking about options here. This is, if you're familiar with options, I just wanted to put out a couple of options change. This is what an option chain looks like. If you're not familiar with an option change, this is what it is. This is for Bristol Myers. This happens to be a stock that I traded the other day. But again, if you look up here, you're seeing the expiration dates. These are the March 15th, March 22nd, March 28th. See these every week. These are the weekly positions. The left side right here, these are calls. These are if you want to go long the stock, this is the call side. The right side is the put side. The puts are always on the puts are always on the right. The calls are always on the left. Question here. Being Canadian, I can't get a TOS account to use the Compass System Trading View or another platform. I have to check on that. Is the Compass System only available on Thinkorswim? No, you can run it on Ninja. You can run it on Ninja. And as Canadian, Brian, if you get Ninja, you can put it on Ninja as well. All right, so this is a option chain for Bristol Myers. So what we've got here is an expiration date. Here's the strike prices. Now the stock was trading right around 54. You can see it's 53.79. So this little column here is highlighted. This tells you what the current strike price is, and this would be considered at the money. This is at the money. What you've got here is a bid price and an ask price. This is what somebody's bidding for it. This is what they're asking for it. So somewhere in the middle of that would probably be where you want to get filled. If you're trying to buy a call on Bristol Myers, you'd probably bid like around 64 cents, 63 cents, try to get filled on it. But that's bid and ask. Now this what here we're going to talk about this. This number right here is called the delta, the one in white. All right, and you can see the delta at 54 is 52. We'll talk about delta. And as you go into the money, as these calls go into the money, because these obviously, if you bought a 52 call, it's already, if the stock's trading at 54, you've already got $2 worth of a value in that thing. So these in the money calls, the delta is going to go higher. Out of the money calls, the delta is going to go lower. All right, same thing on the put side. No different. Everything is structured exactly the same. I just kind of wanted to show you if you haven't done this before, I want you to see what a option chain looks like. And I did one more option chain on Bristol Myers, same thing we just looked at before. But what I did in here was I put OI volume. This is the open interest in the volume. When options are traded, at the beginning of the day, they have what's called open interest. Open interest is all the outstanding options that are still outstanding at that price for that stock. So and you can see here for March 15th, for Bristol Myers, on the $50 call, it's got 11,867 options outstanding, contracts basically. And the number in blue is how many have come through today. That's the volume. The volume is right here. So this is how many options traded today, and this is how many were out there. This 617 will be added to whatever's left as open interest at the end of the day. This is not included in open interest, right? This just tells you how much liquidity there is in the stock, right? So this is just kind of wanted to show you that on the option chain, so you have some idea of what we're talking about when we talk about things like delta, open interest, and volume. But that's an option chain. That's how we trade options. We look at the prices, we look at the volatility, we look at the delta. All right, so what we're going to talk about here in this basic options, I don't want to take all day on this, so I'm going to try to go through it pretty quickly, but there is some information here I think that's really, really useful to everybody. So we're going to cover what are options. We're going to talk about what makes up option premiums. Don't be, a lot of people think trading options is like trading stock. It's not. It's completely different than trading stocks, and you'll see why. What makes up the option premiums? What's intrinsic versus extrinsic value? This is really important. I'm going to talk a little bit about Greeks. I'm not going to go into a lot of the Greeks, but I'm going to talk about some of the ones that it's nice to know about. Question, what company was the option page you showed from? That's from TradeHawk. I use TradeHawk to trade through Tradier. It doesn't make any difference. They would Thinkorswim. All the option chains will look the same with the same information. We're going to talk about strike price and expiration date, volume and open interest, just talked about briefly, primary option trades, and we're going to talk about bullish option strategies, bearish option strategies, neutral option strategies, and option trade setups. All right, so this is a lot of information. I might have been trying to do too much at one time, but I haven't done this before, so I haven't covered it in a video or webinar before. All right, so what are options? Okay, when you buy a stock, you own the stock. You can sell it whenever you want. It goes up, you make money. It goes down, you lose money, but you don't have any time decay on it. You don't have to worry about how long to hold it for. Options are completely different. When you buy an option or sell an option, it has a strike price, it has an expiration date. So that means that if I buy a Microsoft $100 call and the stock is trading at, let's say, 95, which I would never do, then that stock is going to get to $100 before my expiration date. So you have time involved in these. So what the calls and the puts give you is have rights and obligations. If you buy a call or if you buy a put, you have a right to buy that stock at that price. So if I do a $100 call on Microsoft and Microsoft goes to 110, I have the right to that call to exercise that call and buy the stock at 100 and then sell it at 110. Most people don't do that. They just sell it. They just sell the call because it's going to be worth a lot. But you have the key thing here is there when you buy a call or buy a put, you have the right, but you do not have an obligation. You don't have to buy it. You can just keep the you can just sell the option and not worry about it. When you sell a call or sell a put, this switches from right to obligation. You at that point in time when you're selling, for example, a call or selling a put on a stock. If I sell a $100 put on Microsoft and Microsoft is 110, then I'm I'm obligated to supply that stock to somebody who bought that put from me at $100, and I have to go back and buy the stock at 110 and sell it to them at 100, so I lose $10 in the stock. So just remember, if you're selling, you have an obligation. So if the stock goes into the money, you're obligated to, and what you'll get what's called an assignment. The brokerage house will assign you the stock. If you go in with like one put and the stock goes in the money, you'll wake up the next morning and you might have minus 100 shares. All right, so that's the difference between calls and puts, between rights and obligations. So that's buying or selling. So when you buy, you're long a call or a put, which means you're looking for, if you're going along a call, you're looking for the stock to go up. If you're long a put, you're looking for the stock to go down. Pretty easy. When you sell, you're short a call or short a put. When you sell a put, for example, then you're expecting the stock to go up, and you're expecting the stock to go up in price. The put that you sold will then go down in value, and you can buy it back cheaper. Same thing on the call. That's how you do credit spreads, right? So you can buy or sell puts and calls, but just be aware of you're obligated. If you're selling something, you're obligated to supply somebody with the shares if the stock goes against you. So again, buying a call, going long a call is bullish. Selling the call or shorting a call is bearish. So buying a call is bullish, selling a call is bearish. Vice versa on the puts. Buying a put is bearish. You're bearish on the stock. Selling a put is bullish. You're bullish on the stock if you're selling a put. Right? It's just the opposite of the calls. So that's just kind of what options are and what you're actually doing and what you're obligating yourself to if you buy or sell an option. All right. So what makes up an option premium price? When you go to buy an option, there's a market makers are setting a price on that. What's in that price? There's a few things. First of all, options can be at the money, which means if Microsoft's trading 100 and I buy a $100 call, that's an at the money call. If I buy a $95 call option when Microsoft is trading at 100, it is now an in the money call because the stock is actually higher than my strike price. So part of my premium is going to be part of the strike price, how much the stock is worth. So if I buy, for example, a $95 call and the stock's at 100, the premium on the option is going to be at least $5 because that's how much I'm in the money, plus what other premium is added in there. And then out of the money, which is if Microsoft's trading at 100 and I buy a $105 call, that's an out of the money call. The stock hasn't got to that price yet, and I'm looking for it to move up to that price. Okay, and there's some big differences here as how this impacts your trade. So what makes up the option premium? Well, the stock price, obviously. How much? What's the what the stock price is? So again, if the stock price is 95 on Microsoft, and or let's say 100, and I buy a $95 call, then I've got $5 of intrinsic value, it's called, in that option, because the stock is trading higher than what my strike price is on my option. So I've already got $5 automatically into that premium. So it's going to be at least $5 for that particular option. So again, intrinsic value, which we just talked about, on a $95 call on a stock that's trading at 100, you've got $5 of intrinsic value. Implied volatility, which is the volatility, of the stock. How volatile is that stock? And this is what market makers are putting in there. So it's going to be included in the option price. And the last thing that's going to be included in there is what's called time decay. And time decay is a measure of how much time between right now when you own the option and when your expiration date is. So if you've got five weeks worth of time on your option, the time decay is going to be really slow. If you get 3 days of time decay left, in other words, the option expires, you're on Wednesday and the option expires on Friday, time decay is going to be extremely fast. Because remember, when you buy a call or buy a put, it needs to get up to a certain strike price or within a certain strike price above your strike price by a specific date. So that's what makes up the option premium price. Okay. All right. So again, I'm going to just cover this a little bit quick. Let's see what happens here. What happens when you buy a put? When you buy a put, you're basically assuming that the stock, you're looking for the stock to go down. The value of the put, if again, let's use Microsoft at 100, and let's say I buy $102 put, the stock's already at 100. Then I'm looking for the stock to continue down from there. And if the stock goes down, your put value will go up. And what happens when it gets assigned? Gets assigned. If you're short a put or a call and you get assigned the stock, it'll just show up in your portfolio as with a put, it's going to show up as a negative 100 shares. With a call, it's going to show up as a positive 100 shares per contract. Okay, so intrinsic value, we just covered that, but basically it's how much of the option premium is in the money. $50 option on a stock trading at 55 has an intrinsic value of $5. All right, we just talked about that. So you've got intrinsic value of $5 net. The extrinsic value is the option value minus the intrinsic value. So let's say you've got a stock here, stock's trading at 55. You've got a $50 option. Well, you know it's worth at least $5, but the option is going to be worth more than that. You got what's going to cost you more than that. So let's say outside of that, let's say it's $5.75, just for example. So you've got intrinsic value of $5. Your extrinsic value is going to be the 75 cents. In other words, the part of your premium that's not included as part of the intrinsic value. That's the difference. And when you take an auction, you don't want to have a lot of extrinsic value, because this extrinsic value is what's going to decay on you through time decay. As you get closer to the expiration date, the extrinsic value is going to keep dropping. So that's going to knock down the value of your option, as is time decay. So you don't want a lot of extrinsic value. You want to have significant amount of intrinsic value in here. And I'll tell you a little bit about how I do that. And also important is the volume of options traded at the strike price and expiration date as well. We looked at that. You want to have enough option open interest on any option that you trade, so when you want to get out of the trade, that there'll be a market for it. That's basically all that means. All right. Will you give an example of which strike and expirations you pick? I will. Yeah, I'm going to go over that, Ian. I'll tell you that I always buy in the money calls and puts. I will not buy out of the money calls and puts unless it's a very specific condition. I'm always buying in the money, because buying out of the money calls and out of the money puts, in other words, buying a call on Microsoft that when it's trading at 100, buying a $105 call is out of the money. And that particular strategy is an overall loser. Okay, so I'll tell you how we do that. Okay, so these are the Greeks I'm going to cover. The delta, which we looked at. The delta tells you how much the stock option price is going to move in relation to the stock price. So let's say the stock price moves $1. If you've got a delta of 50, the option will move 50 cents. Now, most of the trades, when I get into a trade, I use a delta of 65 to 75. And I'll try to find the best one. But let's say I've got a delta of 70. That means if the stock moves up $1, my option price is going to move up 70 cents. Theta, which is a time decay, this is the decrease in value of the option price as expiration date approaches. Obviously, if you're buying an option, it's going to expire on a certain date. You've got a certain date. The less time that you've got between the current day that you're in the trade and your expiration date, the less time there is for that stock to get to your strike price or up into your strike price. There's less time left for it to move for you, move in your direction. So as the time goes by, they take value out of the option premium based on what's called theta, and they decay at certain rates. But the theta decay, or the time decay on the stock, is much more prevalent during the last few days than it is during, if you're 4 weeks out, you're not going to get much time decay. When you're 4 days out, you're going to get a lot of time decay. And the gamma, and this is an interesting one. This is the rate of change in delta. So if you've got a high gamma on an option price, the price can change dramatically with only a small price change in the stock, because think about the fact that you're in a delta of 70 and the gamma all of a sudden is real high and the stock moves a little bit, and you had a delta of 70 and all of a sudden the delta goes up to 85 because the gamma is how fast the delta changes. Now instead of making 70 cents on a dollar move, you're making 85 cents on a dollar move. And this rate of change in delta is going to be impacted by the volatility. If you've ever looked at a stock that shoots up, like it comes out of the gate and it's just stacking green candles one after another, really, really fast, moving fast, then the volatility is really jacked up. So what happens is the premiums on the options are moving up. A lot of times they're moving up faster than the price of the stock because the gamma has gotten high and the delta is going up faster. So if the stock is shooting up, your premiums, if you own a call, for example, are going to go up faster than the stock price. Maybe the stock goes up $1 and your option premium goes up $1.25. And that sounds great, but it's a double-edged sword, because when the stock stops going up fast and the volatility drops out, even if the stock is going sideways at the same price, now all of a sudden the gamma drops, your volatility comes down. So the stock, if it's going sideways, your premium will start dropping on your option, even though the stock isn't going down in price. So that's why gamma is important. All right, so these are the primary strategies I'm going to talk about. I don't use all of these, but a lot of people are familiar with these. I'm not going to go into every single one, but obviously long calls and puts, these are the simplest ones. What everybody does, buys a call, buys a put, sells a call, sells a put, that you'd be buying for long. Put credit spreads or call credit spreads. This is a strategy to basically collect premium. What credit spreads do basically is collect money as the time gets closer and closer to expiration. What you're doing is you're selling a put or a call, expecting for the premium on that to drop because the fact that it's getting closer and closer to expiration date. And that's what a put credit spread or a call credit spread does. How they make money is by taking advantage of time decay. Now, a put debit spread or a call debit spread is a little different. Well, it's quite different. A put debit spread would be a bullish strategy, a bear strategy, where you buy a put and you sell a lower price put. What these do for you is a couple of things. They limit the cost, so they make it cheaper to take maybe like a short position, but you don't want to pay full price for what the put is going for. Then what you do is you do a debit spread. You buy a put, and then at a lower strike price, you sell a put. And what that does is it reduces your cost on the premium. Same thing with the call debit spread. Then calendar spreads, which is we do in the room, we call them time spreads. Calendar spreads are just basically selling this week's call and buying next week's call at the same strike price. So you've got one expiring this week that you sold, one expiring next week that you bought, and that's how we harvest implied volatility crush, or the premium crush on the option when it's coming out. Because once earnings are announced, the premium comes flying out of those options because there's no more volatility left, because now the market makers know where the price is and which direction it's going in, and it's our job to collect that volatility crush using these time spreads. There's condors, which I don't use, but that's another strategy. Butterflies, which I use occasionally, is another strategy. Strangles and straddles, and I do use strangles. So these are some of the primary option strategies that are there. I think I went into them a little bit here. If you're long a stock, you like a stock bullish, we got bullish, bearish, and neutral option strategies. Each option strategy is based on whether you're bullish or bearish on the stock. So let's say you're bullish on a stock. So here's what you can do. You can buy a long call, you can short a put, you can sell a put, you can buy a put credit spread, or you can do a call debit spread. All of these things are bullish strategies. Any of these strategies, and it's one of the things I have to do is when I look at a stock and I like the stock and I like it bullish, I've got to decide what's the best thing to do here. Bearish strategies are going to be obviously the opposite, short calls. In other words, sell a call, which, by the way, you should never sell a call what's called naked. You should never sell a call unless it's in a spread. You don't want to be selling calls short. It's a nightmare if the stock gets an announcement. If you short a stock and on a call and it gets bought out overnight, you're really in trouble. Bearish options would be long puts, call credit spreads, and put debit spreads. All three of those are bearish options. All right, and neutral options. These would be considered neutral strategies. Doing condors, doing straddles, doing strangles, and doing time spreads. These are non-directional. You don't care which way the trade goes as long as it stays inside the criteria that you want. So you don't really care if the stock's bullish or bearish. You just want it to be neutral. These are what you would use for that. Now we'll make a note here about the short puts and the short calls. When you're selling a put, let's say you sell a put on Microsoft, you'd like to own it at $95. So you sell a $95 put when it's trading at 100 and it drops down to 93. Then you're going to get assigned, but you're also going to keep the premium you collected. So you should only, into my opinion, you should only be shorting stocks like this, doing short puts if you want to own the stock. You should never be shorting calls. This we put in here because it's a bearish strategy. This is an absolute disaster if this doesn't work for you, because again, if you short a call, let's say you're short Microsoft, or let's say you short let's take a stock that's a biotech. You short a biotech call. You think you want to collect some monies on the call, so you're shorting the call. And the biotech company comes out with an FDA announcement, and this thing shoots up 400% overnight. You are screwed. You are screwed. You have to buy that stock back at the hugely inflated, maybe 200–300% higher price to cover your short call. Don't ever do this. All right, but I do want to make sure you know what they are. All right, see if we get any questions here. Is high gamma or low gamma more expensive? High gamma is more expensive. When gamma is high, what they're doing is that they're saying, okay, it's increasing the volatility, so the price of the option is going to increase. That's why when a stock's going up fast and the volatility is going up fast, the gamma is high because the delta is moving up faster because you're making more money on the option than you normally would. But those are specific conditions that create that. Okay, all right. So these are the option strategy setups that I want to go over. And again, I know I'm covering a lot of information here, but I did want to cover as much as I could, make it as inclusive as I possibly can. I know this is quick because learning about option it took me about 5 years. All right, so you do a put credit spread. You're selling a put and buying a put at a lower strike price, and you receive a credit. Anytime you do a credit spread, you're going to receive money in your account. All right, and then you're going to want the stock to stay above that, the put that you sold. You're going to want to stay above that price until expiration, and you keep all that money. Call credit spread, the same thing. Sell a call and buy a call at a higher strike price, looking for that particular stock to stay below your sold call price until expiration. Now, put debit spread is when you buy a put and sell a put at a lower strike price for a debit. You're looking for the stock to go down. And a call debit spread is when you buy a call and sell a call at a higher strike price, looking for the stock price to go up, but reducing the cost on the overall trade. Right there. Those are the, and I use a lot of these. A calendar spread, we just talked about that. That is like the time spread. Sell a put or a call at a near date expiration like we did on Marvel. It was on Thursday. We sold the call expiring Friday, and we bought a call expiring the next Friday. So we were long next week's call and we were short this week's call. That's called a calendar spread or a time spread in the case we're using this week and next week. As I said, that's what a time spread is right here. And a strangle, you hear people talking about strangle, that's to buy a call and buy a put. One strike or more away from the, at the money. So if the stock is trading, let's say Microsoft's trading at 100 and you want to do a strangle on it, you would buy a $101 call, a $99 put. You've got a strangle on Microsoft. So if it goes up or goes down, you can make money as long as it moves enough. And a straddle is like a strangle, except you're buying a call and buying a put for the same strike price and expiration. So in the case of Microsoft, you could buy, let's say you want to do it this week, you would buy a $100 call and a $100 put. You're buying the exact same strike price, but you're buying a put and a call. So you want to make money if it moves in either direction. Because these are at the money, a straddle is more expensive than a strangle. Okay, just so you're aware of that. All right, so I'm going to talk about choosing the best option. This is the strategy that I use, and I didn't put anything down here. I'm just going to talk about this. All right, now the strike price is going to be in the money. So I'm using Microsoft as an example. Microsoft's trading at 100, right? What kind of a strike price am I going to take? Well, I'm going to take something that's about a 70 delta, which is probably going to be about a $96 or a $95 call if the stock's trading at about 100. So they were in the money. So in other words, I'm only using in the money calls and puts. In the money calls for long, in the money puts for shorts, and they should have a delta of around 65 to 75. Now, the higher the delta, the more you're paying for the premium, of course, because it's more deeper in the money. But I found that using about a 65 to 75 delta gives me over time, gives me my best return on investment. A lot of people like to buy at the money because at the money has a lower delta. But the problem is, if you buy like a $100 call when the stock's trading at 100, that would be an at the money. Then as soon as it drops below that 100, all the premium that you've got left in that is made up of time decay and volatility, which means if the stock keeps dropping, all of that premium is going to drain out of that option. If you buy an option that's 95 when the stock's trading at 100, you've got $5 worth of intrinsic value, or the premium of the option is worth at least $5 as long as the stock stays around 100. And as it comes down, you'll have some decay in the price. Of course, the price will go down, but you have so much intrinsic value, a value on that option it's actually part of the strike price, a part of the option price, then it's not going to decay as fast, or it's going to decay as fast, but a smaller portion of the option will decay. I know this can sound a little bit confusing, but believe me, what I'm looking for is I'm looking for a strike price that's in the money, around 65 or 70 delta. Expiration date, a lot of this is depending upon how long I expect to be in the trade. I'm looking for, the further out in time you go, the more expensive it is. But you've got to take into consideration, I take a look at the charts and I'm trying to figure, if I get on Microsoft at 100 and I've got a $95 call, and maybe I think it can go up to 110, how long is it going to take? So typically on my options, I'm going to be 3 weeks out, 4 weeks out or so. That's typically what I do. Now I may actually exit them the same day, but I want to give myself plenty of time in case I need to stay in the trade. And again, so if I had a $100 stock I was trying to buy, I'm probably going to take about a $95 or $96 call, 3 to 4 weeks out, and my delta is going to be around 65 to 75. All right. Now, an interesting note here on choosing the best option. If earnings are coming up, first of all, I never hold trades over earnings. The only trade I do on earnings is a time spread. If I want to buy an option and I can find an option that, let's say the earnings are in 3 weeks. I might go out 4 weeks and buy a 4-week out call. All right. Now, I'm not going to keep it for that 4 weeks because I'm going to be out of the trade before the earnings hit. And you're going to pay more for the option, correct? Because A, it's further out, and B, it's after earnings, which means there's a lot of volatility built into it. But you pay more for the option, but it doesn't decay anywhere near as fast because since it expires after earnings, all of that volatility is going to stay in that option premium until you sell it. And you're going to sell it before earnings. So even though you pay for it, you're not going to have as much downside risk as you would if it expired before earnings. All right, so that's kind of an important thing. So that's basically how I trade options. I mean, it's you know, I'm looking for the perfect strike price. I'm looking for the perfect delta. I have to look at the bid-ask spread, and I want to find something that's got a decent bid-ask spread. So there's a lot more that goes into it than that, but that's the basic thing. And what I will tell you is, please don't buy out of the money options. A lot of people love out of the money options. I can buy it for 40 cents. This thing goes up $3. I'll make 300% on this. Yes, you will. But if it goes down 1%, you're going to lose all of it. And most of the time they expire worthless. All right, that's the takeaway from this. Out of the money options don't produce profits over time. You know, if you take them 1,000 times, you're going to lose money on them. All right, so let me see if I get any questions here. Never seen types of options explained in comparison with much detail. Oh, you're welcome. Yeah, it's important. You know, listen, one of the things what I do when I look at a trade, I like it bullish. I have to make a decision. How am I going to trade this? You know, there's a lot of criteria that go into that, but I got to know how to trade it, and I know what my options are. Okay. Okay, Anthony, that's a great point. Cool. All right, so that is what I'm going to finish with options today, because again, we've been here already an hour, and I want to go over some of the trades that we took in my room and why we took them, because I want you to see that, because that's really important. But I did want to cover this options, and I hope that you found this useful. Again, you can go back over this, you'll get a recap of it. You can look up options information online. You know, there's information on the Black-Scholes model. Options that can be very, very complicated, but I was trying to cover the high points, so maybe you have a better understanding of what they are and how to use them. Okay. All right. So now I'm going to show you some charts of recent trades that I've taken in the room, and I'll show them on Compass, on the Compass system on Thinkorswim, and these are all high probability trade setups, and I'll show you why. All right, so this was Shake Shack. We just took this. This was not long. This was late February we took this. And this is a daily chart on Shake Shack on the Compass system. You notice here, you see this is earnings. You see this compression. You see how it's compressing right here? See the top of that candle? You see where this thing breaks out right here? This is where we took the trade, when it broke out right here, coming off of this compression. Everything's green. We know the institutions are in here buying this. They're buying the heck out of this thing. We bought it here. We kept it for 2 days, and we get out right up here for a 26% profit in 2 days in Shake Shack. Notice everything is staying green here. You notice when it went to yellow, see how the stock starts chopping around, falling down? The current momentum on the daily chart starts to fade. All right, so that's a trade we took. This was one in Workday. Workday, this was a 5-day trade for 30% profit. Now we took it right. Actually, we took it right here. This arrow's in the wrong spot. And you notice this went from blue to yellow, so I had to be cautious here, because it went back to yellow and then it went to blue again. But I like the current time frame. I like the long-term trend, and I also like the price action. I like the price action here on this. And this dynamic compression zone right here, it shows it coming out of this dynamic compression zone and popping up. So we took the trade and we rode it up for 5 days for 30% profit. And get out. I forget where we get out. Somewhere up in here. All right, but again, this I had to use a little bit of common sense in this. I actually get in when it was blue and then went back to yellow. So when I see that, I have to be cognizant of that when I'm looking at the trade to see if this is something that's going to continue, or is this green going to take over the multi-time frame, which it did. This is GCT. This is another one we did just recently. Again, this is a daily chart. Now you see here how this thing is compressing, and I've got, as this went yellow to blue, so I know it's bullish, 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 and I'm in a dynamic compression zone here. I'm looking for this breakout of dynamic compression zone, which it did right here, which is where we took this. We were in it here, and we get out right up here for 26% in 2 days. Institutions are in this trade, so we knew to trade. We only want to trade with institutions. Really, really important. This is another one, MDT. I'll try to go through these fairly quickly. You're going to see the same kind of stuff repeated here. This is MDT, 25% profit on swing trade. Again, this went yellow to blue. Current time frame momentum went blue. Everything else is green. Perfect place to take it. It's riding right along this trend line. This 15 EMA of an EMA. This is a short-term trend that becomes a support level. We take it, and this pink line, by the way, is a VWAP. I do not use this on the daily chart. I only use the 5-minute chart. So this was a trade we took here, and we made 25% on this particular trade as well. Vertex, this was a 3-day trade, same thing. Breaks out here when this big candle breaks above this previous candle. Very bullish. The institutions are in buying it. We just held it for 2 days, 3 days, 30% profit. Vikings Therapeutics is a pretty volatile stock. This was a nice one. This was an overnight trade that we took in McDonald's. We get in the afternoon, get in for 8:30, get out for 11:30 the next morning. $3 profit overnight, 37% gain. Get in here, get out here, see everything's green. I like this breakout of dynamic compression. You see this dynamic compression. Could have bought it here, but I missed it. So bought it here, made a nice move up the next morning, took a nice profit. Everything's green. Crowd. Now here's one we took a 20% profit. We just day traded this. We took it on this day when it broke out of this dynamic compression zone right here after earnings. Everything was blue and green at the time. We took the trade in the morning and we get out in the afternoon for a 20% profit on Crowd, and it kept going up. Amazon, another beautiful one, 45 minutes. Stock moved up again off this 15 EMA. Right here, we get this pop out of the box signal. Everything turns green, except for the long-term trend. The long-term trend was still yellow because the stock had been flat for so long. But we took it here anyway because everything else was green. Got a 32% profit in 45 minutes. This is a 5-minute trade, by the way, a 5-minute chart. All right, so I'm gonna zip through a lot of these because I don't want to take too long. But you can see here. See the compression in ENPH, see the institution selling, see the 20% gain in 1 hour on this thing. These are 5-minute candles. So you get 12 candles and you're out for 20% gain. Pop out of the box, everything's red below the VWAP. Beautiful, beautiful trade for short. Everything's red. Verizon, I do like to talk about this one. This was one, Verizon doesn't move much. It's a very slow moving stock. And you can get the options really, really cheap. So we bought it in the money option on Verizon. We paid 45 cents for it. So 10 contracts was $450. We were in this trade 1 hour, and you see how you get a pop out of the box signal, see the red, selling, but see it's compressing. I don't want to get into this until I see this compression break. Compression breaks here, I buy it here, and I get out in 1 hour, and the 45 cents went to 67 cents. That's 50% gain in 1 hour on Verizon. So if you can catch a stock like that, that's a big gain. 450 in, 670 out, pretty nice gain. All right, and this I just kind of want to cover. This is a SPY super system setup. What we do with the SPY super system is I'm looking at the market internals. I'm looking at the compass. Compass goes all red. It's coming off of a 15 EMA, this little red line with a pop out of the box signal right here. So I know this is good compression break. I know I'm below the VWAP. I go short. I write it down for about 5 candles and I get out. That's called the super system setup. You see everything is red here. Okay, so that's how I know that. And this I just wanted to cover. This was an overnight trade we took in Tesla. You see how it put out a pop out of the box signal on the daily. You see everything is red and green here, red and yellow on the daily. So we took it overnight, and the stock was bearish on the daily chart. I was happy with that. And we got a break here. This is, I mean, you sometimes you have to get lucky. They gap down from 120 to 112 on the open, and then we stayed in this thing. So those puts exploded. I think we made over $7 a contract on those puts. So yeah, that's $700 a contract. That's a lot of money. And again, everything was bearish. We liked the setup on the daily, so we took an overnight risk on that and made out really nicely. All right, so that's all the charts. I get lots and lots of charts like that, but I want to wrap this up because we've been here a long time, and I want to see if there's any other questions. So again, the strategies I use in the options room and the alert service: straight calls and puts, debit spreads and with weekly options expirations, time spreads over earnings, calendar spreads. We use time spreads over earnings. Weekly ATM, we do these only when the market's neutral to bullish. Credit spreads, also neutral to bullish market. Neutral market is fine. I do quite a few of these. And then the SPY super system. That's, except for the SPY super system, these are the trades you'll see on the alert service. All right, so I just want to go over quickly the offer that they have for the alert service and for the room. There will be, there should be, let me look at the chat box. There should be something in the chat box that you can link to to sign up. Hopefully Brock is there and we'll put that out there for us because you need to have something to link to. And let me see. If you can hear me, Brock, put the link out there. If not, this is on the website, and you can also call this number right here and order. But what we've got for the special offer here is on the alert service. It's 50% off. Use coupon code 50%. You get a full year of the alert service for just $7.98, and you saw what the results have been so far. It's pretty worthwhile. Or you can try a quarter for $2.96 if you want to just try it out. Obviously, the annual is much better, but use the coupon code 50. Use the coupon code SAVE200, and this will be good through Sunday. And you also, by the way, you get a month in my live trading room for free, part of that. And you get a Discord. We have a Discord room where we have two other professional traders who post also all day, posting charts, posting high probability trade setups. They have an audio feed where you can actually talk and listen to them. And then I have a Wise Way to Trade Options videos. I got about 25 videos out there on all these things we talked about today. I have one on the options we just talked about. I have that out there. One on all of our options strategies, and also on all the compass indicators and how to use them. I've got one on Heikin-Aji. There's a lot. So you get all of that as well. And then on the live trading room, again, 50% off sale, live trading room, $849 for a year, which by the way includes the alerts. $849 a year, or you can try it for a month for $148. I don't really like the month because I don't think a month gives you enough of a sample of what's going to happen. But I mean, it's up to you. Again, but save $50 on the monthly, save 50% on the yearly. And again, you get the same thing. Obviously, you're in the room for 12 months. You also get the Discord chat and access to the videos. All right, let's see if we get any other questions here. On the SPY puts, what was the premium you had to invest? What I was saying, I don't know exactly what you mean by that. Let me go back and see here. All right, let's keep looking here. I got more questions. Can you use the Thinkorswim in the UK? What capital do you advise starting with? I don't know if you can use. I don't know. You'd have to talk to Thinkorswim. They're owned by I think Schwab or something now. I think they're owned by Schwab. Let's see. Gordon says even in the money options seem to have pretty high implied volatility despite trading in the direction of the daily trend, probably caused by rapid movement. Yeah, absolutely. And listen, each stock has its own implied volatility. There are biotech stocks are extremely volatile, and lately Nvidia, a lot of these stocks, their implied volatility is jacked way up because the stocks have been moving so much. The market makes it trying to protect themselves by raising the price of the options. Let's see. Okay, let's see now. Got a lot of questions here. Can you use, yeah, I don't know about Thinkorswim in UK. You can use Ninja, I think, but I don't know about that. Do your alerts give both when to get in and to get out? Yeah, when I put a trade on, if it doesn't have the sell price on it, which it usually won't, then you'll get another alert with the when I decide to sell it or where I decide to sell it. I'll try to give you a pretty timely heads up on where to set your sell price. It's obviously it's going to be before it gets there. How do I find these trades? Is there a scanner in Ninja? Ninja has a scanner. Thinkorswim has a scanner. I've got a scanner built into Thinkorswim. I also use TC2000 to scan. I have scans in TC2000 because that's where I do most of my deep diving into technical analysis. But yeah, and I've got several scans on Thinkorswim that comes with the compass system. I've got scans for relative strength. I get scans for relative weakness. I've got scans for stocks that are breaking out of compression to the upside and to the downside. Can I talk about position management? What is my typical profit loss target? That's really, really hard to say, Jay. The profit loss target, a lot of it's going to be depending upon multiple things. First of all, the stock and where its resistance levels is or support levels is. What's the market doing that day? On a choppy day, I've got to take quicker profits than I would do on a trending day. Trending day, I can stay in a trade longer. Choppy day, I can't. I've got to take profits pretty quickly. So my profit target is going to be whatever I think it needs to be based on a lot of other criteria, like the stock chart. When I talk about stock charts, I'm talking about the context. What's the context of this stock? How is it trading with the SPY? Is it now losing? Is it have relative strength and now it's losing relative strength to the SPY? Maybe it's time to take profits. There's a lot of things that go into that kind of a decision. And I don't have loss targets. I don't take losses unless my thesis and my support level on as long is breaking down on the daily chart. Once I get into the chart and I'm using a daily, that is going to be my key for getting out for losses. It's going to be based on that. I'm not going to be getting out on some crazy 5-minute candles that come and go during the day. Are you risking 2,000 every trade and the profit is 20% of 2,000? Yeah, if I'm saying that we've made 20% on a trade, if you had 2,000 in there, you'd be making 20%. Listen, nobody uses the same price on every trade. They don't buy 2,000. I don't take 2,000 in every stock. I'm gonna vary how much I put into a stock based on how I feel the market's trending that day. Whether the stock whether the market's trending in my favor, I'll put more money in. Choppy, I'll put less money in. But I had to use something to come up with a comparison to show results month to month. Okay. On SPY put, what was the premium that you had to invest? I don't know. I mean, it depends on the strike price. The premium is going to be dependent upon the strike price. And if I'm putting 2,000 in a trade, for example, I just take the cost of the premium of the option. So if the option is $2, I can buy 10 of them. It's going to cost me $2,000. If I want to risk 1,000, I buy 5 of them. Yeah, would you help set up Compass and Toss? Yeah, I should have mentioned this before. Rightline will set that up. And the link is out there now, by the way. Rightline will, if you buy Toss, Thinkorswim, if you buy, I'm sorry, the Compass system, Toss doesn't cost you anything, so you can put Toss up there. They will, their technician, Sergio, and there's a couple of other technicians down there, they will talk to you. They'll link onto your machine. They'll load up Compass. It'll look exactly like my Compass system did. You'll see exactly the same things that you saw in mine. The scanners will be there, the same scanners I've got. All of that will go on there. They'll set that up for you, and they'll do. You don't have to worry about any of the technical ends of these things. They'll just put that on there for you. What's the least amount of capital is needed in a brokerage account to trade the alerts? Well, a couple things here. If you're gonna most of my alerts, by the way, that you get are going to be most of them are going to be overnight at least. So most of them don't impact what's called PDT, or they have rules for pattern day traders. If you don't have $25,000 in an account, you can only trade 3 day trades every 5 days, and a day trade being getting in and getting out the same day. But most of the alerts are going to be overnight. So most of the alerts, some 70%, 80% of the alerts are not going to be considered day trades. But how much capital is needed in the brokerage account to trade the alerts, that's up to you. How much you want to put into a trade. I mean, if you're going to put $1,000 into an account, it's pretty hard to trade. I mean, you're not going to be able to do an awful lot with it. So it just depends. I mean, you can start with $10,000 and you still run the PDT rules. You can only do 3 day trades every 5 days, but most of the alerts are going to be last overnight, and most of the time they're going to be last longer than that. So, when you get credit spreads, those will be a couple weeks out. They won't impact you as far as a day trade is concerned. Sam, my question was not answered. Sam, you're asking about them setting it up for you, and I think I just covered that. So hopefully that's the one you're talking about. I'm at option price for SPY when you saw a $7 profit per contract. Well, that was on Tesla. I mean, it was in a Tesla I talked about. I can't remember. Yeah, that was on Tesla. It was what was the price on the stock at the time? 112. Yeah, those $7 a contract. We probably had to pay somewhere in the neighborhood of about $9 or $10 for them, for those. I'm guessing, but I know we made $7 on it. But if you bought one, it probably would have cost you about $1,000, $1,100, something like that. Do I post targets and stops? I post my profit target when I decide where I'm going to sell it, but I don't post any stops. I'm going to tell you when I'm going to close a trade out. That becomes my stop, but I don't have a stop. I don't use stop losses. First of all, I don't want the market makers and ECNs to know what my stock price is, but I don't put them in there. I'll put an alert on my chart to let me know if it's got below, but I'm looking at the daily charts anyway, and I know what my thesis was on that, and I know where I thought that stock needed to stay for me to stay in the trade. If it stays above there, then I'll stay in it as long as I feel like it's still worthwhile. And that's what I have to do, because I've found in the past, if you set a stop loss, let's say I'm only going to take a 30% loss on a trade. All right, so your option is $100. Now it's down to $70. I'm 30% down. I'm selling it. Great. Meanwhile, the stock is still bullish, but the option went down in price and it came down some. So now you're out of the trade. You wake up the next morning, the stock just went up $4. So your option went from $1 to $1.75, and you're sitting there on a $30 loss. It's just you just can't trade like that. You cannot set percentages. If I get in at one price and you get in at another price, your percentage loss is going to be based on a different price than mine. You're not using technicals. It's all based on the technicals on the trade. Do I share TC2000 scans? Some of them I do, Sam. Not all of them, but I do have some that I share with folks if they have TC2000. I mean, I've been using TC2000 for about 16 years, so I've done an awful lot of work on TC2000. But if somebody's in the room and they have TC2000, they want a specific scan, they contact me and I'll give it to them. How many trades alerts will we send out in an average day or week? And very hard to say, Terry. Again, our objective is not to make trades. Our objective is to make money. So I send out high probability trades. How many will there be? Usually no more than 2 a day, and a lot of times none a day. I would say on average 5 to 6 a week. That would be the average one. Some weeks it might only be 3. Some weeks it might be 8. But that's about it. Do I have a scanner for TC2000? I get lots of scans for TC2000. Lots of scans for TC2000. I mean, I've spent years building these scans for TC2000. I mean, I have scans for Thinkorswim as well. What's the typical percentage of day trades versus swing trades? Yeah, that's a good question. A lot of it depends. Again, so many things, I hate to keep saying it depends. A lot of this depends on the market. A choppy day, I'm going to probably take profits on day trades if I have them. If I don't have a profit on the day trades, then like we're in Palantir right now. So Palantir went up and got close to our profit target, but didn't make it, and then it pulled back. Well, the daily chart's still bullish, so I don't worry about that. I'm staying in the trade. We're out like 3 weeks with Palantir until to the end of March, so I'll just stay in it. But if it had gotten to my profit target, like let's say it was up 25 or 30% that day, I would have taken profits on it. I might have even entered it the next day. But I would say, for most intents and purposes, I would say probably stocks that we stay in overnight, probably 70%, maybe 75%. Just a guess. Any lifetime pricing for Compass? I think they do, Kumar. I think you would have to call and talk to Rory about that. Rory would again, if you call Rory at 786-732-4656, he can fix you up if that's what you'd like. Compass use 5 minutes as well. Can it be used for occasional day trades? Yeah, absolutely. You can do it on a minute if you want. I use it for day trades a lot. But I only go down to 5-minute charts. I don't go down below that just because it's too much noise. I'm not a scalper. One thing I have to tell you is in the room, the whole focus of my room is to only take high probability trades, not to be on emotional highs and lows trading. We're trying to be very disciplined, very patient, and we have a specific strategy that we follow. And it's like and listen, to be a professional trader and be consistently profitable, you need to treat it as a business. This is a business. It's not like riding a roller coaster at Six Flags, where you get really all pumped up with adrenaline if you have a win, and then you get all depressed if you have a loss. That'll burn you out in no time, which is why I don't like hyper scalping and things like that. Do I look for call walls and puts, walls in the planning? I actually don't do that, Brian. I know people do that. They look at the call walls and the put walls, but I'm just looking at the institutions. And I mean, honestly, if you know where a put wall is or a call wall is, I mean, you're looking at that. You're going to see it in the price action anyway. And usually, if I see stocks starting to lose momentum, unless I'm planning on holding it as a swing, if I go up and see stocks to lose momentum, that's what you usually see at call walls and put walls anyway. Do you get out of a long call if the day time frame, Compass time frame turns to red? Do I get out of a long call if the day time frame, Compass time frame horizontal bars turn red? Again, it depends, because sometimes the daily. If I'm looking at the daily, which would be on the daily chart, I want the daily bullish one. I want it to stay green or blue, and generally they don't just switch over to red automatically. But I'm obviously that's going to catch my attention. But I'm also looking at the technicals on the chart to decide whether that is likely to stay red or will switch back to green again. But it's one of my indicators. Yeah. What broker do I use for my account? I actually use Tradier, and I trade through what's called TradeHawk, which is a front end. All my trades in TradeHawk get fed over to Tradier. Tradier is the account I fund, and it moves over there and trades through there. But I'm not making a recommendation on any brokers. In the past, I've used Interactive, I've used Thinkorswim, I've used Tasty Trade, or Tasty Works, whatever it was, and one other one. I've used like 4 or 5 different ones. I use TradeHawk with Tradier because I don't pay any commissions. I pay like 20, 30 bucks a month, flat fee, no charge for options or stock. That's why I do it. And I do so many options. I mean, I do thousands and thousands of option contracts a month. So. You have shown impressive P&L of 25,000 on the website. What would you say the total money invested? It depends. If for that, if I'm using, let's say I did 20 trades or 25 trades to get to that. You had to put 2,000 in each trade. You'd have to figure it out from there. But I'm basing that on $2,000 per trade, and it just depends on how many trades we take. So, but you know, you don't have that all tied up at one time. Usually there's no more. You don't have more than 4 or 5 at the maximum trades open. Very rarely do I go past that. It's too hard to manage anymore. There are rumors that we might have a correction soon. How does that play into my strategies? It doesn't. I don't listen. If you're trying to predict the market and base your trading on what you think is going to happen or what some analysts think is going to happen, somebody in CNBC says we're expecting a correction. Well, sure, we're going to get a correction, but what are you going to do? Start shorting the market and have the thing go up and crush you? I've known so many people who shorted what they expected a correction or a recession to be. They short the market. Believe me, they get carried out in body bags. Their money's gone. You trade the market. I just trade the market. The problem you see is if you're listening to news about, okay, there's a correction coming. Now in your mind, you've planted the idea that the market's going to turn around and go down. So what happens? Well, if you're in a long stock and it starts to show a little weakness, all of a sudden your mind is saying, oh, this could be the correction starting. I better get out. You're basing your trading on some preconceived notion. I'm just trading what the market's telling me. What's the market doing? I like it, I'm out. You know, if I like it, I'm staying in. If it turns on me, I'm going down. I'm not trying to predict the market. It's just crazy. I mean, it's crazy. I get asked so many times, why did the market do this? Why did the market do that? Everybody's got an answer for it, but nobody knows. The market does what the market does. You know, if you don't have a really good high probability strategy set up that's going to get you 85% wins or higher, then you're at the whims of the market. And you know the market, the overall market, basically, it seems like its objective is to inflict as much financial pain on as many traders as possible. And you don't want to be one of them. We take our money from retail traders, not from institutions. So, all right, Sam, you're welcome. Have I ever had back-to-back losing months? No, not yet. I started in January of 2022. When I first started trading, I did, of course. But I started this room in 2022, which, by the way, was the first month of the bear market, when the market turned around. And since then, I've had 2 losing months, one of about 400 and something bucks, I think, and one of 1,000, something like that. 2 losing months. They were not back-to-back. So I've never had 2 back-to-back losing months since I've started the room. This is 24, 25. I have 26 full months right now, 24 winning months, 2 losing months. And January and February were probably our 2 strongest months. But, you know, listen, the results are going to be a lot of it. The market influences how well you do. If January and February were nice, strong months in the market, market was going up. I know a lot of traders who think, oh, trading is easy now. I just pick a stock and I make money. Well, that's what a lot of people thought with NVIDIA going into Friday, and all of a sudden it's not so easy anymore. NVIDIA takes a big plummet. These things are getting too high. It's really, really important to understand that the market drives everything. So when I'm in the room, I have the S&P 500, the SPY up on the chart all day long. I'll go back and forth to different charts. But when I'm not looking at specific charts, I leave the SPY up there, because knowing what the market's doing is incredibly important. It drives like 75 to 80% of the stocks. So you've got to be aware of what the market's doing. It changes when you may get into a stock or stay in a trade or not stay in a trade. The market is deciding so much for me that it's important to know that. You call it CNBC, yeah, I'm sure. How much for the trading room after a month? I think it's, let me see. 198 if you just take it on the monthly basis. You know, I mean, everybody can do what they want. I mean, I showed the results. That's fine. You can try it for a month. That's not a problem with that. I just think, like on the alert service, you know, for 798 bucks for what you saw for the results, it's pretty damn good. Where does the money flow data come from? Yeah, there's a couple of different criteria in there for money flows. That I don't even want to get into, can't get into, because I didn't write the code for this. So the Compass system was developed before I knew about it. I just noticed, what I noticed when I purchased the Compass system, which I did, I bought it because I wasn't working, I wasn't doing a room at the time. I just noticed that the results I was getting for the last few years were fine. I mean, I was doing 82, 83% win rate, but I noticed it was much more difficult. A lot of the setups that had been working in the past weren't working anymore. And my suspicion was that the algos that the institutions use were actually writing code to bust people in trades that they were taking. In other words, they knew what the strategies like MACD crossovers and things like that, and they can write code to do that. And what I was looking for was some way to find when the institutions were in a trade. I was using volume and I was using relative strength and relative weakness, and that gives you a pretty good indication. But when I added the Compass system, all of a sudden, when I was using that and skipping trades, I was skipping trades that I would have taken before. Now my win rate went up to between 85 and 90% consistently. It doesn't sound like a big difference. It's a huge difference. If you're making 80% of your trades, or you're winning on 88.5 or 88% of your trades, it makes a huge difference. Let's see. Would I advise trading based on the alerts, even if I'm not familiar with the Compass trading system? Oh yeah, a lot of people don't have the Compass trading system. Just know that the alerts are coming from, that's one of the criteria I'm using when I put the trade out there in the alerts. But yeah, I mean, you on the alert service, you don't need to have the Compass trading system, but I just want you to, I want everybody to be aware of where these trades are coming from. So you can look at a chart and see why I took it. How is the alert service different than the trading room besides offering more short trades? Well, that's about, I mean, all the trades that go out on the alert service, I'm taking in the room. So I'm in the room, I'm looking at trades, I'm telling everybody this is a trade I'm looking at. Boom, I'm going to take the trade. I send out the alert, I take it in the room. But there's trades I take in the room, such as the SPY Super System, such as a trade that I think is only good for a day trade. In other words, maybe a half an hour or 45 minutes. I'm not going to alert on that. That's why there's more trades in the room than there is on the alert service. And in the room we're talking about trades all the time. In other words, I'm throwing out trades and telling people this is a high probability trade. I'm not necessarily taking it because I can't take everything that we talk about, but other people take some of those trades. So we're talking about trades. We're looking at the charts. We're discussing how this is a high probability trade setup and why I think this is a good setup. So that, you get all that education in the room. You also get other trades besides the ones that you're seeing in the alert service, or even ones that I take in the room. Do you pay separately for the Compass system to be added to TOS? Yeah, the Compass system is separate. You would buy it from Brightline down there, and they'll put it on your Thinkorswim platform. Let's see. Do we pay separately? Yep. I do not get anything for saying this, but if you listen to this man, who's this? Oh, Jack. Jack's giving me a testimonial here. If you listen to this man day after day, there's a very high probability you will walk away with a lot more profits and losses. I listen. He's been with me a while. I have, to kind of toot my horn here about the room. I've got a lot of people that signed up with me in January of 2022, and they didn't know me from Adam, and they're still in the room. So that's good. Jack's been there a year and a half. Thank you, Jack. Appreciate it. He went to Brightline, but didn't see the platforms that the Compass system is on. Yeah, I would call him to get the information, but it should be out there. The Compass system is out there. What is the average option contract price for the Compass program? What is the option contract price for the? I don't think I understand that question. What is the average option contract price for the Compass system? I mean, the option contract price doesn't have anything to do with the Compass system. And what I pay for an option is dependent upon how much, what the expiration date is and the premium on it. That has nothing, I don't know, I think you may be trying to ask something else. I don't know what that means. All the alerts you send, trades you taken, everything I post in the room. I have a pad that I post in the room with the trades that we've taken and then we're in, etc. All of those trades I take, and anything that goes in the alert service, I take. I take all those. Excuse me, I had to sneeze. All right, sorry about that, another sneeze. Yes, I take all the trades that you get and all the trades that are in the room, because it's funny when I'm down money on a trade, and you know, people in the room will say, we're down money on Palantir. And I say, I know, I'm in the trade. I can see it right here on my portfolio. I take them all. I don't send out a trade or post a trade in the room that I haven't taken. I'm in it. And the alert service, how often does the setup you recommend actually is tradable when the price changes by the moment? Other servers make recommendations when you try to place the order, the prices change so much. Well, you know, what I recommend on this, and of course I send the alert out as fast as I can. And I get them on my phone, so I know how fast they're coming. And it's inside of a minute. But yeah, if a stock is moving really fast, that's why I usually put a price in there of $1.05 to $1.10. Now, my recommendation is if you can't get filled, then you keep the price out there, because most of the time the stocks, almost always, the stocks will pull back. And I'm not doing an awful lot of trades where I'm in that I'm alerting to that I'm going to be in and out half an hour later. It's not going to happen. You know, so if you just wait, the stock will almost always pull back, and you'll be able to get filled. Sometimes you get filled at a better price. McNatt, appreciate that. Appreciate that. Thank you. Anything vision, anything like that, you've got to talk to Rory about that. I don't make any decisions on pricing or anything like that. Listen, I'm not a professional presenter. I'm not a salesperson. I'm a trader, and I'm trying to do the best I can, making a presentation on stuff that I think will be very helpful to other traders. Is this trade room access separate from the alert service? If you get into the alert service, you don't get the trade room. If you become a member of the trade room, you get the alert service. Alert service is part of the trade room, but you can get it by itself. A lot of people don't want to be in the trade room. Personally, I think it's not that much more to buy buy the room and the alert service, because you get them both together. And even if you can only come into the room a couple times a week, it's pretty good. Any guarantee? Yep. Again, guarantee on what? I mean, guarantee that you're going to make money? I don't understand about guarantees. Money got guarantee for what? You know, you're in a month and you don't make money. I just don't think, it's crazy. I mean, because I'm giving you trades and I can show you what they're doing, and I know how well they're going to react. I don't know how you're going to trade them, and I'm not satisfied with this. Well, you know, no, I don't think they give. I don't have any control over any of that. You can talk to them about it, but apparently not is correct. Yeah, I mean, when I bought the Compass system, did I want a money back guarantee that I'm gonna all of a sudden make money? I'm gonna make more money? Listen, whether you make money trading or not, I'm giving the best information that I can, with high probability trade setups that I know are working. But I can't guarantee anybody's going to make money. Nobody does. All right, I think that's all the questions I've covered. I'm sorry we took so long. It's been on here a good long time. I hope the information for you was useful. And yeah, Charles, really, if that's what you want to do, please talk to Rory. Give him a call and talk to him. Tell him what your concerns are, and see what they say. I don't know. I can't make any decisions like that. But again, I appreciate everybody coming here. So we've got a lot of people today. I appreciate that. I hope you found the information on options helpful. It's a fairly complex issue to try to cover in a webinar in a short period of time, but I did the very best I could. So again, thanks very much, everybody. Have a great weekend. Hope to see some folks in the room next week. What's that, Albert? Have I taken any NVIDIA trades with the bullish moves? I've traded NVIDIA several times. But you know, when the stock gets extended like NVIDIA is, and I'll tell you what I look at, by the way, is on a stock, I can see how far it's gotten away from the 8 exponential moving average, and if it's too far extended, then I'm not going to wait for it to pull back. And it sure pulled back on Friday a lot. But yeah, I've traded NVIDIA several times. I have debit spreads on it because it's fairly expensive, and I've bought some straight calls on it, paid, but I'm not. It's not something I'm in right now. Yeah, Doug says people can pay for a quarter and paper trade to see if they like it. Yeah, I mean, you can trade any of that, and you can do that any way you want. Again, it's you know, let's face it, everybody's responsible for their own profits and losses. I can tell you what I'm doing. That's all I can do. Earnings trades, the only trades I do on earnings, Albert, is I do time spreads over earnings. I don't take any straight calls or straight puts or anything like that. I do time spreads over earnings. That's it. Because it's too, listen, the premium on options over earnings are jacked up to the sky because the market makers don't know two things. They don't know if where the stock is going, up or down, and they don't know how much it's going up or down based on earnings. So they move the premium prices way up to protect themselves. So try to get long or short a stock prior to earnings is crazy. It's crazy. If it's got to go in the direction you think, and it's got to go by more than what the market makers think it's going to go up. If a stock is expected to move 15% and you buy a call on it, it has to go up because if it goes down, you lose. And it has to go up, and it's got to go up well more than 15% because you're paying 15% additional for the premium on the option. It's just, it's a losing proposition to make trades over earnings unless you're doing time spreads. Because time spreads, all I'm doing is capturing volatility crush when the earnings come out. I bet you couldn't agree more. Well, I'm glad to hear that because it's a fact. All right, everybody, have a great afternoon. Thanks so much for being here, everybody. I appreciate it. We have a lot of people in here, so hope to see some folks in the alert service or in the room. If you're in the room, please say hello when you come in. Have a great one. Hope to see you folks on Monday morning.